Lots of people going through refinances this year, and with interest rates still low, if you haven't refinanced yet, you may be doing so soon. What are the drawbacks to doing something called a cash out refi? Well, there's three big ones, okay? But there's one huge benefit. We're going to talk about the pros and cons of that and more coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Speaking of smashing, we've likely smashed every record out there as far as the number of refinance applications and refinances that have been done in one single year. 2020, interest rates dropped to record lows, of course. The Fed has said they're going to keep their really short-term interest rate, the one they get to influence, they're going to keep that as low as possible for as long as possible. And so we've had mortgage rates at record lows. And tons of people, that's helped make the housing market really, really strong. And it's also meant lots of people have been refinancing their mortgage. Getting more and more people asking about cash out refinances and whether that's a good idea or a bad idea. And it just depends on your circumstance. As always, you've got to look at all 6 areas of your financial life. But if that's just an option, a cash out refi, and you've got other options as well, there are 3 glaring drawbacks with the cash out refi, but all with one huge benefit that you've got to weigh. Actually, before we get in there, let me just set the stage. What is a cash out refinance? If your mortgage is, say, $200,000, but your house is worth $300,000, so you've got equity there. If you've got other loans that you want to clean up, or you got a house project, or you need some cash, then when you go to refinance, instead of just refinancing your $200,000 loan, you could refinance, say, $225,000. And now your new mortgage is $225,000 instead of $200,000. And what do you do with the difference? Well, that's cash out. You pull that cash, that equity, out of your house, out of the equity in your house, and now you've got a check for $25,000 or whatever the number is. So it's basically refinancing your mortgage to a higher mortgage balance so that you've got extra cash that you can then do something with. I should have started with that. I'm glad I remembered before I got into the details. So it seems like a good deal. You're using some of the equity when you refinance. So what are the glaring problems with this? There are 3. Number 1 is when you do that, you typically are going to get a higher interest rate than you would if you just did a normal refinance. Now, I'm not talking wildly different. So if 30-year rates are at 3% and you do a cash out refinance, it's not going to be 6%, but it might be 3.25. And over the life, 30 years of a mortgage, just to get your hands on this example, $25,000, you're going to have to pay a higher interest rate on all $225,000. That is a drawback. And oftentimes we just look at that as, oh, well, that interest rate's still good. Or we just look at what that does to our little monthly payment, well, sometimes not so little, monthly payment, and we say, well, that's not that big of a deal. But when you extrapolate that over 15 years or 30 years, that's a significant cost increase because you've got a higher interest rate. So that's the first thing. If you're going out there and you're looking at interest rates saying, should I refinance or not? You likely will make an emotional decision. If you're not working with your certified financial planner, you'll likely make an emotional decision and say, yeah, that interest rate that I just saw online, that's a lot better than what I've got. I'm going to go do that. And then you get sucked in, you're thinking about it. And then when you say, I'm doing a cash out refinance to, pay off this other debt or whatever, you don't get that interest rate that you saw, you get a slightly higher one. And you're going to have to sign off and you'll see all of that. But it's already when you're sort of emotionally invested in the process and maybe already signing documents and into the process. So just be aware, a cash out refinance means you're actually going to have a higher interest rate than you normally would. The second big drawback of the cash out refi is typically you're going to have higher closing costs as well. I was just working with a client of mine on this, and they're looking at, should we finish the basement? Now, this is a pretty typical situation. They built their house about 10 years ago, and based on the costs of building a new house, they decided, well, we do want to finish the basement at some point. We've got young kids, but geez, we just can't afford to do it right now. So we'll delay it. We'll set everything up. We'll set the plumbing. We'll stud it and everything, but we're not going to finish the basement. We'll do that cost later. Well, that cost it's something they've been saving up for. Well, and now is time, it makes sense for them to refinance their existing mortgage. And he sent me an email and he said, listen, we've got about $25,000 saved up for the basement. We need probably another 25 more. Should we just refinance and take 25 additional cash out and now we can just do the basement? I love the idea. And we first had to look at what's the difference in interest rate. But the second is you could see it plain as day on the quotes that he had, his good faith estimates for just a normal refinance. This particular lender was charging a loan origination fee of $500. But on the cash out refinance, I mean, right there, apples to apples, you could see the loan origination fee was $1,000 for the cash out refinance. Now that's not a big deal, but if you have other options of getting your hands on that cash, and you don't need to pull it out of the equity of your house, if you look at that, that's an extra $500 fee on getting your hands on $25,000, or say it's only $10,000. That extra cost should weigh into the consideration, okay? So cash out refinance can be very good. We'll talk about that in just a second, but typically higher interest rate and typically higher closing costs. The last drawback is often one that gets ignored. And let's go, for example, let's take this basement example. Okay, they're saving up dollars. It was going to take them another couple of years to save up the other $25,000 to finish this basement. But instead, by borrowing the money, they're going to pay interest on that money for 15 years. Instead of waiting 2 years and not having to pay interest to anyone, they're choosing to pay a low interest rate, yes, but they're choosing to pay interest on that money, on that borrowed money for 15 years. Take, for example, the car loan. If you're going to do a cash out refinance and you've got a car loan that maybe still has 4 years left on it, and you say, you know what, it would be so nice to just pay that loan off, and when I refinance, and it'll be one less payment. Well, now you're stretching that car loan out over 15 or 30 years. Yes, it's at a lower interest rate, but you're paying on it for more years, and you actually could be paying more interest over the life of that borrowed money, over the life of that loan, than you would otherwise. So you've got to make sure, you've got to have that tough conversation with yourself and maybe run those numbers with your certified financial planner to see, is the cash out refinance definitely helping you, or is it actually giving you the illusion of help, but actually costing you more over the long term? So what is the big benefit then? I mean, we've done cash out refinances for lots of folks. Those are the three things that most people don't quite realize, and we've got to point out before we say, yeah, this thing's a go, we should do it, okay? So you got to be aware of those three. Why would you still do it? Because sometimes that interest rate that you're getting by on that equity is so extremely low, it makes a ton of sense. If you've got credit card loans, if you've got maybe some other loans, a personal loan, if you've got other loans that are costing you 7, 8, 9, 10%, and you can pay all of those off and consolidate your payment at an interest rate of 3%, even though it's a little bit higher than what a normal interest rate would be, even though the closing costs might be a little bit higher, and even though you're going to be paying on that loan for a much longer time, it may make sense. That could be an enormous advantage to clean up 4 or 5 other loans that all have significantly higher interest rates and lock it into one loan, one payment. And because of the cash flow that would usually be freed up, many people look at, when they're doing a cash out refinance to pay off other debt, continuing to pay the same amount on their mortgage, and that gets the loan paid off in less than 15 years or less than 30 years. So the cash out refinance makes a ton of sense for lots of people. It may make sense to you. Make sure you're aware of those 3 major drawbacks. Work with your certified financial planner to see if the benefit outweighs the cost. If you don't have a CFP, you can contact a member of my team. Find us online, Korhorn.com. That's Korhorn with a K, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.